FAR.F3.M3.
Inventory always sounds simple until the CPA exam gets involved. Jenna, everybody thinks I know what inventory is. It's stuff sitting on shelves. Then Becca turns it into FOB shipping point, consignments, lower of cost or market, lower of cost or net realizable value, FIFO, LIFO, weighted average, perpetual systems, periodic systems, and suddenly your grocery store has become a graduate-level accounting puzzle.
That's because inventory isn't really about shelves. It's about answering 4 questions over and over. Who owns it? What belongs in inventory? How much is it worth? And how do we assign costs when we sell it? If listeners keep those 4 questions in mind, almost everything in this module falls into place.
So today we're going to build a mental map instead of memorizing isolated rules. Every new topic should answer one of those 4 questions.
Exactly. And Becker's past keys emphasize understanding the big ideas first, because many exam questions are really asking whether you know which rule book you're supposed to open.
Let's start with ownership. This is where accounting feels a little like deciding whose driveway the package is sitting in.
That's actually a useful analogy. Inventory belongs to whoever legally owns it, not necessarily whoever physically has it. That's why shipping terms matter.
Because if it's December 31st and a truck is halfway across the country, somebody owns those goods.
Right. Under FOB shipping point, ownership transfers when the seller ships the goods. Under FOB destination, ownership transfers when the buyer receives them. So before asking what inventory is worth, you first ask whether it's even yours.
The exam loves year-end cutoffs because they're testing whether you stop and ask that ownership question first.
Exactly. Don't immediately start valuing inventory if the ownership hasn't even been established.
Now, let's talk about consigned goods because this one tricks people. I picture asking my neighbor to sell my bicycle for me. The bike isn't theirs just because it's in the garage.
Perfect. That's exactly what consignment is. The consignee is simply holding and selling the inventory. The consignor still owns it until it is sold to an outside customer. That means consigned goods remain in the consignor's inventory.
So location isn't ownership. Just because something is sitting somewhere doesn't mean it belongs there.
That's one of the biggest themes of this module. Possession and ownership are not always the same thing.
Now we move to the second question. What actually goes into inventory? Because inventory isn't just the purchase price.
Correct. Inventory includes all costs necessary to get the inventory ready for sale. The idea is simple. Ask yourself what it took to prepare these goods for their intended use. If the cost was necessary to get inventory ready for sale, it generally belongs in inventory.
So we're building the full cost of getting the product onto the shelf, not just the sticker price.
Exactly. That's why Becker keeps emphasizing historical cost as the starting point.
Then accounting throws us a curveball. Sometimes cost isn't the number we use anymore.
Right. Inventory isn't always reported at cost. Sometimes its usefulness has declined. That's where lower of cost and the various valuation rules come into play.
This is probably where students start mixing everything together. Lower of cost and market. Lower of cost and net realizable value. Market ceilings. Market floors. It starts sounding like a real estate seminar.
The easiest way to organize it is by asking one question. Which valuation rule applies? Don't try to memorize every formula first. Identify the framework.
So, explain the difference.
For most inventory under USGAAP, Becker teaches lower of cost or net realizable value. Net realizable value is essentially expected selling price minus the costs required to complete and dispose of the inventory. If that amount falls below cost, inventory is written down.
Simple enough. Compare cost against what you realistically expect to recover. Take the lower amount.
Exactly. But there's an important exception. When inventory is accounted for using LIFO or the retail inventory method, Becker teaches lower of cost or market.
Which introduces market. Except market doesn't simply mean today's price.
Exactly. Market generally starts with replacement cost. But replacement cost cannot go above the market ceiling. And it cannot go below the market floor. Only after finding the proper market amount do you compare it to historical cost.
Here's my analogy. Imagine replacement cost is a dog running through a fenced yard. The dog can run around, but the fence keeps it from wandering too high or too low.
I like that. Replacement cost has freedom, but only inside the ceiling and floor established by the rules. That helps explain why students shouldn't automatically assume market equals replacement cost every time.
And Becker also points out something important. Once inventory is written down under US GAAP, those write-downs generally aren't reversed.
Correct. That's an easy detail to overlook.
Now, let's switch gears. Periodic versus perpetual inventory. People sometimes think this is just about journal entries. But it feels more like two different ways of keeping score during a game.
That's a great analogy. A perpetual system updates inventory continuously. Every purchase and every sale immediately changes inventory records. A periodic system waits. Inventory is updated after a physical count at the end of the period.
One scoreboard updates after every basket. The other waits until the final buzzer.
Exactly. Both eventually arrive at inventory information. They just collect it differently.
That also explains why perpetual systems record cost of goods sold immediately when inventory is sold, while periodic systems wait until period end.
Right. Don't think of one as better accounting. Think of them as different information systems.
Now we get to probably the most famous topic: cost flow assumptions. Which inventory costs left the building?
Notice what you just said. Costs left. Not necessarily the physical goods. That's one of the biggest conceptual ideas. Cost flow does not have to match physical flow.
That feels strange at first. You could physically sell the oldest boxes first, while accounting assumes the newest costs were sold.
Exactly. These methods are assumptions about assigning costs. They're not necessarily descriptions of warehouse operations.
Let's start with FIFO.
First in, first out. The oldest inventory costs are assigned to cost of goods sold first. Ending inventory, therefore, consists of the newest costs.
I imagine a grocery store selling older milk first, so it doesn't expire. That matches the accounting assumption.
Often it does. And Becker's passkey emphasizes an important consequence. During periods of rising prices, FIFO generally produces the highest ending inventory, the lowest cost of goods sold, and therefore the highest net income.
That's worth understanding instead of memorizing. Newer costs are usually higher during inflation. If those higher costs stay on the balance sheet, inventory becomes larger. Older, cheaper costs move into cost of goods sold. So expenses are lower. Income goes up.
Exactly. If you understand that chain of logic, you don't have to memorize disconnected facts.
Now, LIFO flips the story.
Yes. Last in, first out assigns the newest costs to cost of goods sold first. Older costs remain in ending inventory. During rising prices, Becker teaches that LIFO generally produces the lowest ending inventory, the highest cost of goods sold, and the lowest net income.
So if prices are climbing, LIFO immediately recognizes those more expensive purchases as expense.
Correct. That's why the financial statement effects reverse compared with FIFO.
Another Becker passkey. Whenever they mention rising prices, my brain immediately asks, are we talking FIFO or LIFO? Everything else follows from there.
Exactly. The direction of prices matters. Don't memorize results without first identifying the environment.
Weighted average feels like the referee trying to stop the argument. Nobody's first. Nobody's last. Everybody gets averaged.
That's actually a great way to remember it. Weighted average smooths cost differences. Instead of emphasizing oldest or newest costs, it spreads costs across units.
And moving average.
Think of moving average as weighted average's cousin that lives inside a perpetual inventory system. Every new purchase creates a new average, so the average moves throughout the year.
Instead of calculating one average at the end, you're constantly recalculating after purchases.
Exactly.
Now, let's briefly touch on specific identification.
Specific identification tracks the actual cost of individual items. This works well when every item is unique or high value. Think expensive jewelry, artwork, or custom equipment. It isn't practical for identical boxes of breakfast cereal.
Unless somebody really loves individually naming cereal boxes.
Let's hope not.
Dollar value LIFO scares people because of the calculations.
For this podcast, remember the concept. Dollar value LIFO measures inventory in dollar pools rather than tracking individual physical units. The purpose is simplifying LIFO when inventories are large and constantly changing. Becker walks through the mechanics separately. The conceptual takeaway is enough to build your mental framework before working practice problems.
Good. Listeners can let the calculations live in the textbook while keeping the big picture in their heads.
Exactly.
Now, let's visit the gross profit method. This sounds fancy, but really it's estimating inventory.
That's exactly right. The gross profit method estimates ending inventory using historical gross profit percentages. It's useful when a physical count isn't available, such as interim reporting or after events like inventory losses.
So we're making an educated estimate instead of counting every box.
Yes, it's an estimate built from historical relationships, not a replacement for an actual physical inventory.
Then Becker finishes with firm purchase commitments.
A firm purchase commitment is a legally enforceable agreement to purchase goods in the future. If the contracted purchase price exceeds market and a loss is expected, Becker teaches that the expected loss may need to be recognized before the purchase actually occurs.
That's another example of accounting trying to recognize economic reality instead of waiting until cash changes hands.
Exactly.
Let's wrap everything together. Suppose I see an inventory question. What's my checklist?
Start with ownership. Do we actually own these goods? FOB terms. Consigned goods. Year-end cutoffs. Then determine what belongs in inventory. After that, ask how inventory should be valued. Historical cost? Lower of cost? Or net realizable value? Or lower of cost? Or market because LIFO or retail inventory is involved? Then determine which inventory system is being used. Periodic or perpetual. Finally, identify the cost flow assumption. FIFO, LIFO, weighted average, moving average, specific identification, or dollar value LIFO.
I like that because it prevents jumping into calculations before understanding the problem.
Exactly. Accounting questions often reward asking the right question before performing the math.
One last memory trick. Imagine inventory as a warehouse with 4 locked doors. Door 1 asks, do you own it? Door 2 asks, what belongs inside? Door 3 asks, what's it worth today? Door 4 asks, which costs left the warehouse? Every topic in this module fits behind one of those doors.
That's the mental map I want listeners to leave with. Don't memorize isolated rules. See how they connect. Ownership determines inclusion. Inclusion determines valuation. Valuation determines reporting. And cost flow assumptions determine how costs move between inventory and cost of goods sold. If you can consistently organize inventory questions that way, Becker's details become much easier to remember because they each have a logical place within the overall framework.
And that's inventory. It turns out accounting isn't asking you to memorize an entire warehouse. It's asking you to ask the right questions about it.